Hopefully everyone can.
Yep.
Yep, great. Okay, good. Okay, well, welcome to COVID. Navigating out of COVID, Jobkeeper 2. These are pretty new laws that came in last week. Obviously, there's a few things I've got to tell you about, which is basically we don't want any errors. Hopefully there isn't any, and obviously seek your own advice at the end of it if you're going to undertake this Jobkeeper 2 and you're not sure. First of all, thank you to everyone. This is information that we've been trying to give over the last sort of 6 months. It seems like 6 months now, probably since March. I've worked out probably given about 25 Zoom presentations over the last 6 months, and this is a way of our way of helping you guys through a tough time. So, so tell all your friends, and also for those that already have given us a Google review, thank you very much. I'll talk about that at the end. And also thank you for the team that helps you, because behind me is a team, especially Vicky, who does a lot of the Jobkeeper stuff, and they certainly tell me all the answers that I don't know. So tonight we're going to discuss a few things. Jobkeeper 2 and are you eligible? What's new to Jobkeeper? The different types of tier of payments, the 80-hour rule for the tier of payments, and the tips and facts. Obviously, most of the source of information has come from the ATO in the last week or so. So there's a new way of determining whether you can meet into the new Jobkeeper, and that's basically looking at your turnover. It's not a monthly turnover, it's not a projected turnover. It's basically a decline in turnover calculated by comparing the September 2019 quarter with the September 2020 quarter. The monthly calculations no longer apply, and you need to use the turnover from your BAS, including your capital receipts. So if you do your BAS on a cash basis, that's how you'll determine your turnover. If you do it on a accrual basis, you'll use the accruals, because the previous Jobkeeper allowed you to use the either alternative methods. So we spent a bit of time with some of you working out which was the best method to use, and now it's a lot more straightforward in the fact that you only have one method, and that's the BAS method. However, there's obviously a few exceptions that we'll talk about. There is 7 alternative tests for Jobkeeper 2 for the turnover. So if for various reasons you have had certain circumstances happen to you, you can apply to use these alternative tests with the Commissioner. And these are that the business commenced on the first day of the relevant comparison period, but before the 1st of March. There was a business acquisition or disposal that changed the entity's turnover. There was a business restructure, or there was a substantial increase in the turnover, or the business was affected by natural drought or disaster. Or in the case of a seasonal business, you might have had irregular turnover. Sole traders and small partnerships with sickness or injury or leave can also apply that last particular measure. So some of us will not be registered for GST, so you have a choice of which method you use. So you can either use cash or accruals. You need to keep good records of your choice. Now, for those that aren't aware, accruals basically means you're taking into account your debtors, people that owe you money for that quarter. So that's not what you've received in cash, but what sales you've invoiced. So in your case, you've got a choice to work out which would be best, and then you need to keep good records. Do you need to enrol for the Jobkeeper under the new extended Jobkeeper rules? All entities currently on Jobkeeper must again satisfy the new decline of turnover test. However, they don't need to re-enroll. So if obviously you've come to the end of your Jobkeeper 1, by not putting in your next particular monthly declaration will mean that you won't be going into Jobkeeper 2. But obviously, if you do satisfy the turnover test, you need to keep those records on file in case the tax office ever look for it. With new entrants, you obviously need to enrol and obtain the employee nomination forms and go through the whole thing that you guys would have gone through in March. Those employers previously enrolled in Jobkeeper do not need to notify your employees again. However, you'll need to look at those. At the end of December, what will happen? Businesses and not-for-profits will need to further reassess their eligibility in January for the period, for the final period of JobKeeper. So it's in two lots of payments. Businesses and not-for-profits will also need to demonstrate that they have met the relevant decline in turnover for the December quarter to remain eligible to the March quarter. So you can enter into the JobKeeper system at any stage, and you can also drop out at the end of either this coming month or at the end of December. A few ATO JobKeeper reminders. Remind your employee to tell you straight away if any of the information you have on the employee nomination form has changed. So that means that you might have an employee who also has another job or has decided to get JobKeeper from one of the other employers, so they can't get it twice. So just check with your employees to make sure they still wish to continue on the JobKeeper system. Watch out for scams. The ATO will not phone you to ask about JobKeeper. They'll probably send you information via email or text. JobKeeper is not a payment that you receive as an employee. Is receiving your employer by your employer to reimburse them for wages that they have paid to you. So what they're saying is it's not an automatic thing. It's up to the employer to decide whether they wish to enter into the scheme. So the payment for the December quarter is basically two tiers. We have the first tier, which is basically for full-time employees at $1,200 per fortnight. And that's for people that have worked in the business for 20 hours or more. And for those that work less than 20 hours per week on average, it'll be $750 per fortnight. So there's the two basic payments, and that will obviously go down further to $1,650 in the final quarter next year. But this is where there's a little bit of spin in the tail. So JobKeeper will continue to be paid in arrears, so you still have to pay your employees equal to or greater than the amount of the JobKeeper based on the payment rate that applies for each employee. Employers will have until the 31st of October to ensure they've met the wage conditions for the respective fortnight, starting today actually, and finish. And obviously the 12th of October is the next one. We want to make sure we meet those criteria. And then of course you'll be reimbursed in November for October's payments. So you'll still get the September payment, which we'll obviously do in the coming week or so. And then for those that can't show a decrease, so they'll go off JobKeeper. And for those that can, will continue to receive it. Are your employees still eligible? You don't need to reassess your employee eligibility or ask employees to agree to be nominated by you if you're already claiming them before the 28th of September. The reference period for employees regarding their hours worked to determine the tier of payment will be 2 fortnightly pay periods prior to the 1st of March or 1st of July, depending on when they come on board. The period with the higher number of hours is to be used by employees who are eligible at the 1st of March. So basically we go back to February and have a look and see how many hours they've worked. So the eligibility rules for employees have changed slightly. If they're currently employed by an eligible employer, you can basically continue to pay them. If they're employed full-time, part-time or fixed term, as at the 1st July 2020 and not a permanent employee of any other employer, they meet the obligations. They're 18 or older at the 1st July 2020 or 16 or 17, they can also qualify if they're independent or not taking full-time study. So if you've got any of those sort of ones, just check in with us. They were Australian resident or Australian residents for the purposes of income tax assessment. They were not in receipt of government parent leave or dad and partner pay or a payment according to the Australian Workers' Compensation. And the self-employed were eligible to receive JobKeeper payment when they meet the relevant turnover test and are not a permanent employee of another employer. So just be careful on that one. We've had a few part-time people that are employed somewhere part-time and that's a permanent position, and they haven't quite met the test to be able to get Jobkeeper in their own right. Things to know about the process. Some of these are repeating them, but it's just a reinforcement of what needs to be done. You can enrol at any time until the program closes, so between now and the next 6 months. You can't go back. I think once you've missed the date, that's it. If you're already enrolled in Jobkeeper, you do not need to re-enroll for the extension. You'll need to check the actual decline in turnover for continuing eligibility from the 1st of October and again on the 1st of January 2021. Once confirmed, you'll need to submit this information to us online. Now, I'm not sure, I haven't seen any information yet on how that's done. If we have to do that, we'll just wait and see what happens there. By the 14th of each month, complete the Make a Business monthly declaration to claim the Jobkeeper payments for the previous month. So there's nothing new there that we already are doing. And you should also make any updates to your employees' eligibility where you're no longer receiving Jobkeeper payments for using the maintain function as part of your monthly declaration. So if you've got any employees that have left, then you need, or changed hours, you'll then need to obviously update that information. Sole traders. So this is an interesting one for sole traders and business participants. So they're people like that are running family trusts and not getting wages. Sole traders or small partnerships with sickness and injury or leave. The new alternative test for sole traders or partnerships affected by the sole trader not working for a period of time. That means that there's a revised test now that uses the current GST turnover for the month immediately before the month the sole trader went into work. So sorry, this is an alternative test for the sole traders to test whether they're eligible to continue on. There's also some tests over the 80 hours, which we'll get to in a sec. New changes for turnover tests. So there's a substantial increase in the turnover test for entities that in their current GST turnover. You'll now be eligible to choose between using the period immediately before the turnover test or before the 1st of March. And it's the same with the irregular turnover test. So there's a series of percentages when we go back over the next 1 month, 3 months, 6 months, and 12 months, and we can use either of those depending on your situation. So if you feel that that might apply to you, just let us know. We can look into whether we can get the Commissioner's agreement on that to apply to you. So, as alluded to, for the final quarter of Jobkeeper, at this stage, there's the $1,000 per fortnight for eligible employees who'll be working in the business more than 20 hours, and then $650 per fortnight for other eligible employees working less than 20 hours. So that's in January. Obviously, tomorrow night we've got the budget coming out, so some of these may change, but I think this is pretty set in stone. The reference period. So this is the interesting difference between the last time and this time. So there's a reference period for Tier 1 and Tier 2 payments. The reference period is used to determine whether an employee is eligible for the higher or lower amounts of pay. The applicable reference periods are the 28-day period ending at the end of the most recent pay cycle for the employee that ended before 1st of March, and the 28-day period ending for the most recent pay cycle for the employee that ended 1st of July, entered into it. So for existing ones, we go back to March, February, and for the new employees that are coming in for the 1st of July, we go back to June and have a look at the hours. Employers are required to determine the hours that count towards the calculation during the reference period. This comprises of actual hours the employee worked and any hours for which they receive paid leave. So annual leave, long service leave, carers leave, and other forms of leave, or absence from paid absence for public holidays. So basically, any time that your employees were employed is able to be included for the reference period. So the reference period, again, is important for determining whether you're getting the increase of $1,200 or the $750. Determining 80 hours. Your employee will satisfy the 80 hours threshold in their 28-day reference period. And the total of the following is 80 hours or more. The actual hours they worked, the hours they were paid leave, the hours they were paid for absence of public holiday. If your eligible employee satisfied the 80-hour threshold, you can claim the Tier 1, which is a higher payment rate for them. So if they don't meet the 80-hour threshold, you can only claim the Tier 2, which is the lower rate. If you have incomplete records, the total hours, there'll be some circumstance which the commissioner will allow you to claim the Tier 1 payment for the rate for them. So basically, this is an average. So we're looking at 4 weeks. Anything above the 80 hours, which is 20 hours per week, obviously will get more. Anyone below that will get less. Determining employees where there is insufficient records. So there's going to be circumstances where you don't have sufficient records to justify the employee's hours, and that may be where you're paid commission, bonuses, or allowances, and they're not related to an hourly rate. If your records have been destroyed, most clients shouldn't have records that have been destroyed now. The tax office doesn't like wage records being destroyed or not being kept. If you don't have sufficient records, there are 3 circumstances you can claim the Tier 1 rate for. You paid your employee $1,500 or more during the 28-day reference period. You had a written agreement for your employee to work 80 hours or more during the 28-day reference period. Or there is a reasonable assumption that can be made that your employee worked at least 80 hours during the 28-day reference period. If you're unable to satisfy one of the 3 circumstances above, you should consider whether one of the 2 other circumstances apply. So basically, I think the best thing to do is make sure you have good records, because the tax office could ask whether that would, your records to see whether you've claimed the right rate. Things that don't count towards the eligible employees' 80 hours are unpaid leave, government-funded parent leave, workers' compensation, things like that. So just be mindful if you've got any of those in your employee list. So a lot of our clients are on the business, regarded as business participant, and they satisfy the 80 hours threshold if they're actively engaged in your business for 80 hours or more during the reference period and have provided a written declaration confirming this. The ATO suggests records to prove the 80 hours over the 29-day period would be include business diaries, appointment books, logbooks, invoices, timesheets, and attendance records. This one will cause a little bit of confusion for some people, because obviously you might not have a lot of income at the moment, or back when you decided to choose your 80-hour test, and will need to be able to satisfy the tax office why you're claiming the $1,200 instead of the $750. So it's important that especially if your business is starting out or it doesn't have a lot of income, you've actually kept good records, because it might be possible that you're working pretty hard to meet that 80 hours, and on the face of it, on the books, it doesn't look the same as what it should look, so what the tax office will see. So good records will get you out of a bit of a hole, and we can help you there if you're a little bit confused or a little bit stuck on how to document that. But I think that's going to be important for people if they want to claim that $1,200. So you need to be actively engaged to be a business participant, and that's worth a review. An individual will be actively engaged in the business they're carried on if they regularly perform services, manage the sale of goods or services in the business, perform other activities associated with managing the business, the books, and answering the phone and doing all the back end, exercise control over the activities relating to the business strategy, and an individual will not be actively engaged in the business simply because they own an interest in the business or provide advice or assistance from time to time, or a silent partner. So just be careful on that. I think that's a clarification on saying that you just can't nominate yourself as a business participant if you actually aren't one. Most cases, I think all our clients are actively involved in their businesses, so they would satisfy that. So the business participant area is certainly an area that you need to make sure you have some documents on file to show that you're actually actively involved in your business and you've met the 80-hour rule. We haven't talked about what sort of worksheet we'll prepare, but I'm sure we'll put something together over the next couple of days to help you. Use the alternative reference period if you're eligible business participants when the total of active engagement in your business was less than the 80 hours in February, and compared to earlier 29-day periods, February is not representative of your eligible business participants' typical number of hours. So in this case, we could use another alternative period if February isn't a typical time that you would spend in your business because you're away or sick or whatever, or there was fires or drought or something in your business that affected the hours that you would work. So we can have a look at that, and if that's your case, yell out and we'll see if we can help you there. Jobkeeper versus job seeker. We're still getting quite a few comments about this particular aspect. Some people would have lost their work, so these people would go on to Jobkeeper, seeker payments as opposed to Jobkeeper. So Jobkeeper is basically run by the employers for the employees, whereas the job seeker program is run for those that are basically not in employment. So there's the two aspects there, and that's important because sometimes we've had a few clients where there's been a bit of pressure on the client to go into Jobkeeper because obviously with the higher threshold, so we're getting a bit more money than they would have under job seeker, but it's not always the case. So it's really for us as small business people, we need to just focus on whether we're eligible for Jobkeeper, and if we're not, we then move on. If we are, then you can put your staff members onto it. The ATO, according to the press, have undertaken some audit activity. The things that they've found include falsification of records, claim for ghost employees, workers claiming from multiple employers, and the compliance activity will continue to run until the end of the year. They'll include data matching and verification. And obviously, you've got to include that income in your entity's tax return, which we're doing a check as we're going through to make sure that you are, because the tax office will want to note that. So it's taxable income in your company tax return or your trust tax return or your individual, but obviously you don't have to pay GST on it. So that's important to make a note of that. And and the tax officer will obviously be pleased to see that you've included that income. I've heard of examples of various employees trying to claim Jobkeeper over a number of different employers. Apparently, they'll be asked to repay that money with interest back to the ATO. So hopefully that won't come back on yourself unless you've been part of that process to assist the employee. So it's obviously on your side to make sure that you do the eligible checks, but other than that, sometimes fraud happens because you're unaware of it. And I think the tax office will chase down those particular employees. Next Monday night, I thought I'd leave some of this till next week, and I thought we'd talk about Zoom and your business, Google reviews and your website, social media, and what you should be doing in the roadmap out, because there's a bit to take in tonight with Jobkeeper. I'm going to open it up to questions and see if there's anyone that has some questions that I haven't answered